I'm Howie Lim. This is Money Hacks by the Business Times. Apparently, a recent survey revealed that nearly 70% of Gen Z and millennial investors globally allocate over 20% of their portfolios to companies or funds focused on good corporate practices. That's a lot, I feel. This greater exposure to speculative assets, heightened risk tolerance, and heavy reliance on social media seems like a recipe for disaster. So how can we assess thematic investment and manage behavioural biases so we can stay focused on long-term goals while embracing innovation and one's values? Welcome to Money Hacks, a podcast series by the Business Times, where we explore useful financial tips to help you on your money managing and wealth growing journey. I'm Howie Lim. And helping us out today, Steward Thum from Phillip Securities and Patrick Hong from Morrisons Capital.
Hi, thanks for having me. Well, I think that, investment trends have changed quite drastically, especially over the last, I would say 3 years has been a really huge quantum leap, especially during the COVID period, where you see a lot of AI-driven stuff going along the way as well. So, naturally the market is a lot more robust. Things move a lot quicker. So for the younger generation, employment trends have changed a lot over the last few years. So you can see that there is a different mindset, and a lot of it comes from, I would say, from their upbringing to, all your social media stuff, like, your YouTube, your TikTok and things like that, the kind of content that is filtered to them. So a lot of it is, some of it is very volatile stuff, like, they look into things like your crypto and things like that. So for some of them who are probably not so savvy into the market, there tends to be this mentality of, a get rich quick system that they try to make money very quickly. But, it works both ways. You can make it very quickly, you will lose it very quickly as well. So, on our end, on the advisory fund, we don't really deal with so many younger clients. More so sometimes it's, the children of those clients where they start to look at, potentially what their parents are doing in the investment markets from their insurance policies and things like that. And then they start to learn along the way. So sometimes that very subtle upbringing from a younger age really determines how the mindset is built over time as well.
This simple investing strategy, value investing, has played a major role in driving Warren Buffett's wealth to about $160 billion. Only. Before you get all excited, do we even know what it entails or what we're doing? Briefly, value investing selects stocks by analyzing a company's financial information to determine the stock's intrinsic value. If the value is higher than the current share price, the investor considers the stock to be undervalued and therefore a potentially good investment. And value-driven investing often encompasses things like environmental, social, and governance criteria, sustainable finance, and impact investing. And it looks like younger investors are increasingly gearing towards this direction. Here's Steward Thum, Financial Services Associate Director at Phillip Securities.
Many feel a strong sense of stewardship, and investing becomes more than just growing the money. It is a way to shape the society and the economy that they want to see in the future. Gen Z and millennials, they have grown up amid escalating climate change, social inequalities, and global challenges like 2008 global financial crisis and also COVID-19. And all this bring a sense of urgency to them, and the awareness makes them more likely to view things like sustainability, as a financial priority, whether it's supporting companies that focus on environmental innovation, fair labor practices, or even, social infrastructure. There is also a growing confidence of the young investors that these options, in fact, offer comparable or, if not, better returns. Some people think that value-driven investing is not about returns, and most investors, in fact, reject the ideas that value-driven investing comes at the cost of performance. Most agree that it is possible to achieve financial gains or focusing on the positive environmental or social outcomes.
So it's really about, if you like certain sector, it could be maybe your ESG side of things, like environmentally friendly and things like that. But at the end of the day, the business needs to be profitable. There has to be a real solid fundamental angle towards it. So sometimes, just about reading the news may not be the most accurate thing, if you read about certain countries. That's why, the source of the news is very important. Who's the person writing it as well? But to me, the best way that I actually do is I will go to the place, I will go and check out the company. I like to have an on-the-ground experience to see, what actually is going on here. Are these companies actually solid? Does this business model actually make sense in the longer term? Will the market actually adopt it over time? you may have on paper the best product, but if nobody uses it, you have no sales, it will never move as well, you see. So it is actually very practical applications. It's just that sometimes in terms of the media, how things are spun up, for more hype and publicity, I would say people misinterpret things or people interpret things in a different way as well.
That's Patrick Hong again from Bill Morrisons Capital. Still to come, practical strategies to balance personal values and portfolio construction, and how to manage your behavioural risks. More with Patrick Hong and Steward Thum from Phillip Securities in a moment.
Breaking news from the Business Times podcast team.
Hi guys, this is Emily Liu, your host of Market Focus Daily. I've got some great news. Come July, Market Focus is getting bigger. I'll be bringing in market and investment experts into the studio to share analysis and opinions on what moved the markets and what to look out for in the week ahead. Every Friday, starting on July 4th.
Look out for Market Focus Weekly from the Business Times or wherever you get your podcasts.
And now, back to Money Hacks from the Business Times.
Welcome back. So we've talked about how younger investors are increasingly veering towards value-driven investments and how that needn't be at the expense of performance, as is the long-held belief. So how can one balance personal values with disciplined portfolio construction? After all, most still invest for the sake of profit, I'm sure. Here's Patrick Hong from Bill Morrisons Capital.
I think generally we always set a target. Don't be overly greedy. Take profits along the way. Reason is that profits are not profits until you actually realize it. You can have a portfolio that is huge, but if you don't realize the profit, they're just a piece of paper, the stock that you're actually holding, for example, right? So we don't encourage profit taking over time, looking at maybe undervalued sectors that potentially are, valuation is looking a little bit cheaper, or something that potentially the market misses. So not always chasing the stock that is always hyped by the media that, prices are sky high and things will continuously go up. There's always cases that share prices go parabolic, like let's say I think Nvidia is a very good example. But the logic behind it is that will it keep going up forever? The company cannot keep growing forever. It looks good maybe for the next couple of years, but there will be a point that, the competition catches up with them and, the share price will start to fall off as well. So it's all about the market cycles. And I think the regular investor needs to be very aware that, when things start to move up in different directions, probably not to keep chasing the highs all the time. That's very dangerous. Sometimes if you miss it, you miss it. There are thousands of stocks in the market that you'll be able to find another opportunity. So sometimes patience actually plays a very big part. Sometimes I always tell our clients, and I stand by the theory that first, if I can't allocate my own funds into it, I won't put your funds into it. The next thing will be, I'd rather be at a net zero returns rather than be unsure and be negative. So I always feel that, prudence plays a very big part that, as you really take care of your downside more, you'll start to see that the upside will start to creep in a lot better as well.
So I think awareness of this biases is key to better outcomes. Okay, as an example, like EV, it takes a lot of policies support. Without all these subsidies, in the long run, that means from the start, the subsidies are there, but after the subsidies is taken away, can this sector still continue to sustain? And then I think the research or rather the follow-ups, the follow-throughs on studying this company or these sectors is very important instead of just a short-term hype from the start. Coming back, there could always be a misalignment between the values and the assets characteristics. Things like speculative assets often conflict with these ESG principles. For example, cryptocurrencies like Bitcoin, it consumes massive energy. It's equivalent to accelerating global warming. The value versus the asset characteristics. Of course, there are always this thing called ESG compliant crypto, but what's the substance behind? So I think these are the things that we probably got to look into it. And of course, there are also some regions like China, which is heavily relying on coal. It may clash with values. And I think second, a strong belief in a mission can lead to concentrating too much capital in unproven industries.
Oh no, sounds like we're heading into psych territory almost. Behavioral psychology and the like.
Well, there's a lot of things that bugs me.
Okay, pick one.
The main thing that bugs me really is the FOMO thing, like when the stock starts to move, when asset prices start to inflate, then people start to go in. I always feel that when news hits the media, the mainstream, I always feel that you're too late. You only get it right when you're there before the whole move actually happens, which I generally feel that's the case. And that will always be about maybe the sharpness of your analysis in the markets as well.
I think we always invest when we strongly believe in a certain company or, certain sectors. And that strong belief may cause the investor to find it hard to cut loss sometimes. So, of course, I think when it's very underperforming, the reviews, I think the review on investments, whether the policy have changed, whether the geopolitical situation has changed, the regulatory shifts and all this, I think is important. Thematic investing involves a lot of targeting specific trends or mega trends, such as AI, renewable energy, biotech, and all this. I think in 2025 example, the theme like AI adoption, technology innovation, economic, and all these discussions. And of course, assets under management in thematic funds has projected a huge growth amid market volatility. However, over concentration, allocating too heavy into a single theme can amplify risk. Even last year, look at Magnificent Seven. It seems like a diversification, but in fact, they are all chasing AIs. So in fact, the Magnificent Sevens are making up of the whole index. So these are the things that maybe we can put on a more balanced view.
Oh man, might not be as easy as following in Warren Buffett's footsteps, which are reportedly 16. That's huge. Okay. Takeaway order, Money Hacks episode 233 is up. While value investing could mean potential riches, Warren Buffett-type riches, it takes patience and FOMO is real. So be careful of chasing hypes that can lead to financial faceplants. Thank you to Patrick Hong, Managing Partner and Investment Strategy and Treasury Specialist at Morrisons Capital, and Steward Thum, Financial Services Associate Director at Phillip Securities. I'm Howie Lim, and this has been Money Hacks by the Business Times.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.